Now let us have a look at the receipt sides and the expenditure side. First of all, we will be looking at the receipt side. Now these particular terms are important. These particular terms are important. Different segmentations are important because you must know that what different parts are covered under what different types. Okay, so we'll be covering those, and these will really help you out so as to solve the case studies. So first of all, it is related to receipt sides, that is the revenue receipts. So revenue receipts are related to what? Those receipts, either these are related to direct taxes, or these are related to the non-tax revenues. So either these are related to tax revenues or non-tax revenues. So we will be looking at the tax revenues first of all. So let us have a look at the gross tax revenue, that is the aggregate of all the taxes. So first of all, it is related to corporation tax, whatever the taxes being paid by the corporates, income tax that is paid by the individuals, companies, HUF, that is on the income so earned, and further it is related to other taxes and duties which are not otherwise specified, which that will be covered over here. Then it is related to customs. So whensoever the taxes to be paid on imports, export, or it may be related to the boundaries, whenever the goods are being exported to some other state or related to it, then that case the custom tax is basically imposed. And for the union excise duties, it is related to tax on production, service tax that you such as the GST etc., VAT etc., that is basically the service tax. Taxes of the union territories means the taxes which is basically paid by the union territory itself, that is a taxes which are paid by the union territories itself, that is the UTs. Okay, so that is basically what, that is your gross tax revenue. So these are basically 7 type of taxes over there. You need to remember the names exactly: corporation tax, income tax, other taxes, customs, union excise duties, service tax, and taxes of the union territories. Okay, and for the net tax revenue, there is a term called net tax revenue. What it is actually, whatsoever the tax which is received by the central government itself. Let us take the case of the central government itself. Whatsoever the tax is basically received by the central government itself, that is basically a particular fund is formed out of it. So whatsoever the total tax is received, it is called the gross tax revenue. It is called the gross tax revenue. I am writing it as in the shorthand, that is a GTR. And for the out of this GTR, that is a gross tax revenue, the amount as such, the NCCD that is transferred to the National Calamity Contingency Duty. Okay, so it is basically related to what? It is related to National Calamity Contingency Duty. So it's a fund which is created out of these taxes so received, which can be utilized in the case of the calamities or in the case of the exigency. Okay, so that is basically to be subtracted, and further whatsoever the share that is to be paid to the state government itself, because government needs what? Government needs the revenue, whether it is the state government or the central government, they need the revenue says to run the government itself. Okay, so as for the working itself. Okay, but now in this particular case, central government is receiving the taxes, and further a share of it may be the case that the share is to be paid to the different states over there. So that particular share will be subtracted, and also the NCCD will be subtracted. So these two components will be subtracted from the GTR. And that will be basically net tax revenue to the government. Okay, so gross tax revenue that was earned, and further subtracting the NCCD, that is the National Calamity Contingency Fund, NCCF, or which we say NCCD, that is a National Calamity Contingency Duty, and further the state's share that is to be subtracted, and that will be the net tax revenue. Okay, after that it is related to the non-tax revenue. Other than the tax income, also government is earning something, that is basically the non-tax revenue. It may be the interest receipts. So whatsoever the amount which is lent by the government itself, it may be the case that the government is earning interest on it. So that will be basically interest receipt. That is also covered under what? That is also covered under the revenue receipts. And for the dividends and profits, so if the government has invested into some companies, or the government has invested into some instruments or some instruments over there, in that particular case the government will be earning the profits or dividend over it. So that is also covered under what? Also covered under the non-tax revenue. That is also covered under the non-tax revenue. It may also be the case that the external grants have been given, or it may be the case other non-tax revenue must be there, or it may be the case receipts of union territories. That is also covered under the non-tax revenue. So the total revenue receipt, it is equal to net tax revenue plus the total non-tax revenue, that is your total revenue receipt. That is basically your total revenue receipt. It is sum total of net tax revenue and plus the total non-tax revenue. Okay, so that is your total revenue receipt. And further, it is related to the capital receipts. It is related to the capital receipts. So either it will be in the form of the debt receipt or it will be in the form of the non-debt receipt. When we talk about the non-debt receipt, it will be covering all the different different dimensions which are not related to loans, and advances. So let us take the case that if you have received the recoveries of loans and advances, if you have received the recoveries of loans or advances, but I already told you that in this particular case, recovery of the short-term borrowings will not be considered. Recovery of the short-term borrowings will not be considered because we have already considered it under the non-tax revenue under the revenue receipts. Is that clear? Further, if it is related to miscellaneous capital receipts, that will also be covered over there. Then it is related to the debt receipts. So it may be the case that the government has borrowed from the market or from the short-term borrowings may be there. It may be the case that the government has borrowed the external assistance may be there, or it may be the case securities issued against the small savings or state provident funds may be there. Other receipts can be there. So it is all related to what? That is all related to the debt receipts. It is all related to the debt receipts. We have mentioned at the rate over here. That is basically the signing to over here. That is related to excluding the recovery from the short-term loans and advances from the state itself. Okay. In this particular case, the recovery from short-term loans and advances, that is to be excluded. Is that clear? Is that particular part clear over here? So we can say the total receipts are equal to what? Total receipts are equal to total revenue receipts plus the total capital receipts and plus the drawdown of cash balance, that will be taking as such. The drawdown of cash balance will be taken as such. Now, what is drawdown of cash balance? It is not that much important from the syllabus point of view and from the exam point of view, but you must have an idea related to it. That what is a drawdown of cash balance. So let us take the case that a security was worth rupees 75, but now due to the market yield it is worth rupees 100 rupees over here. It is worth rupees 100 over here. Now the 25 difference is what? This is the drawdown cash balance. This is the drawdown balance, or we can simply say the drawdown cash balance. So if the Reserve Bank of India has provided the assistance based upon, or the Reserve Bank of India has basically invested in the secondary market into the treasury bills or the government rated securities. Now if the prices are higher, in that case it would be basically what? It would be the drawdown cash balance. Okay, so that is to be taken as such. That is to be taken as such. It will not be covered into the revenue receipts. It will not be covered into the capital receipts. It will be taken as such. So the total receipts will be sum total of 3 terms. That is the total revenue receipts, which is basically sum total of what? It is a sum total of the net tax revenue plus the total non-tax revenue. And the capital receipts is sum total of what? It is sum total of the debt receipts and the non-debt receipts. Okay, plus the drawdown balance. That is the total receipts. That is equal to the total receipts. Now let us have a look at the expenditure side over here. So in the case of the expenditure side, we will be covering it as the non-planned expenditure and the planned expenditure. First of all, we will be covering the components related to the revenue expenditure. That is for the day-to-day expenses of the government departments. Okay, so interest payment or prepayment of the payment itself. It may be the case that the interest is to be paid, or it may be the case that the prepayment of the loan is to be paid. It may be the expenses related to day-to-day expenses we are talking about over here, related to defense, related to subsidies, or it may be the case grantees have been paid to the states or the union territory governments, or pensions have been paid, police expenses over there, or assistance to states from the National Calamity Contingency Funds. So if an assistance has been paid to the states from the NCCF, in that case also it is basically related to the revenue expenditure. And further the economic services or the other criteria mentioned over here, all these are related to what? All those are basically the types of the revenue expenditure. And we are covering it under what? We are covering it under the non-planned expenditure. This is not planned because these are not the schemes which have been formulated it under the 5-year plan case. Okay, so that is why we have covered them under the non-planned expenditure. So we will be covering it into two parts, expenditures into two parts. One, it is a non-planned expenditure. We will be covering the revenue expenditure and the capital expenditure in that particular thing, and further we will be covering the planned expenditure, in which we will be covering it again, that is the revenue expenditure and the capital expenditure under the planned expenditure. Okay, now let's have a look at the capital expenditure under the non-planned expenditure. So it may be related to defense or other non-planned capital outlay, loans to public enterprises, loans to state and UT governments, loans to foreign governments, it may be the case. So those are all related to capital expenditure, where you have invested the amount either for the long terms, where we have invested the amount either for the long terms, or you have lent the amount for the long terms. Okay, and now let us have a look at the non-planned expenditure. It is sum total of revenue non-planned expenditure plus the capital non-planned expenditure. Now let us have a look at the planned expenditure itself. Further, it is classified into two parts, that is the revenue expenditure and the capital expenditure. Under the capital expenditure, revenue expenditure. So if there is a central plan, you have you have made the expenses related to that, but those expenses are for day-to-day purposes. That is for the working of the government itself. Then it will be covered under the revenue expenditure, and central assistance for the state and union territory plans. So that will be covered under the planned expenditure, and also the same components would be under the under the planned expenditure for the capital expenditure. So if it is for a short term period, it is basically revenue expenditure. If it is for a longer period, it will be basically what? It will be the capital expenditure over here. Is that clear? So we can say the planned expenditure total is equal to revenue expenditure plus the capital expenditure, and the total expenditure is equal to total non-planned expenditure plus the total plan expenditure. So that is basically sum total of total expenditure and further the total receipts over there, total expenditure and total receipts over there. And financing of the fiscal deficit. What is basically fiscal deficit? So union budget is basically related to what? It is an outlay of whatsoever the revenues we will be having and what will be related to future expenses. Okay, what will be the future revenues and what will be the future expenses? That is related to the budget itself. And further, if the difference is over there, let us take the case that your expenditures are exceeding the receipts. Your expenditures are exceeding the receipt. In that case, there is a deficit in between. There is a gap in between that is to be bridged out. In that case, that gap can be bridged out by the way of financing itself. Okay, and financing of fiscal deficit is equal to what? Debt receipt. So whatsoever the amount which we have received in the form of the debts plus drawdown of the cash balance, where we have drawn the balances in the form of the cash, that is basically what? That is basically your financing of the fiscal deficit. That means this particular part, that is the sum total of two terms. One, it is related to debt receipts, and the other one, it is a drawdown of the cash balances. These have been basically taken as the debt itself. Okay, these are related to financing of the fiscal deficit. Is that clear? Is that particular part clear over here?